Two buyers walk into the same dealership on the same afternoon, both earning exactly $75,000 a year. They're eyeing the exact same car, a $40,000 new model, sitting under the showroom lights. One drives home financing with a loan, the other drives home in a 5-year-old version, paid in cash. Most videos on this new tax break stop at one flashy number and never check who gets to keep it. Here is what almost nobody explains correctly: that write-off can be worth $10,000, or it can be worth exactly zero. By the end of this video, you will know which buyer walks away richer once the real math gets run. We're going to price the loan interest, the depreciation, and the actual tax savings, one honest number at a time. We'll even rerun this same choice for a buyer earning far more, just to watch the math flip completely. So which one wins? The new car with the tax break, or the used car with none of the debt? That open question is the whole video, so let's set the stage properly before picking a side. Meet our two buyers. Same job, same paycheck, same $40,000 sitting between them and a car. Buyer 1 finances a brand new American-assembled vehicle and plans to claim every deduction the law allows. Buyer 2 skips the new car entirely and buys a comparable model that's already a few years old in cash. Neither buyer is reckless, and neither is foolish. They're simply choosing two different paths to the same destination. This deduction only exists because of a tax law passed under the current administration, so the rules are genuinely brand new. Most drivers have never had to think about car interest and their tax return in the same sentence before. So let's start exactly where every other finance video on this topic usually stops, right at the headline number everyone remembers. Under the new rule, a buyer can deduct up to $10,000 of car loan interest every single year. That deduction applies even if the buyer takes the standard deduction and never itemizes a single other expense. It only applies to new vehicles, not used ones, and the car must weigh under 14,000 pounds. The loan also has to be a first lien on the vehicle itself, not a personal loan or a credit line. Leases are excluded entirely. Choose to lease that shiny new car, and this deduction never applies at all. On paper, that sounds like the government simply handing new car buyers a straightforward yearly tax discount for buying new. Plenty of headlines ran with exactly that framing the moment the law passed, and viewers understandably got excited. But a maximum written into a tax code and a number that lands in a buyer's pocket are two very different things. The used cash buyer, meanwhile, gets none of this. No interest paid, so nothing to write off in the first place. That sounds like a clean loss for the cash buyer on paper until the rest of the math gets counted honestly. So far, this looks like an easy win for financing new. The question is whether that headline survives contact with reality. It doesn't, not fully, and the first crack in that number is hiding in the buyer's own paycheck. That crack is called the income phase-out, and it's the part almost every other video on this topic skips. For a single filer, the deduction starts shrinking the moment modified adjusted gross income passes $100,000. For every $1,000 a single filer earns above that line, the deduction shrinks a little further. That works out to $200 shaved off the allowed deduction for every step above the line. Push a single filer's income high enough, and the whole deduction disappears completely by $150,000. Married couples filing jointly get a wider lane, with their deduction gone once combined income passes $250,000. File separately from a spouse, and this deduction isn't available at all, no matter the income level. So a meaningful share of new car buyers earning solid ordinary incomes end up with a deduction of exactly zero. That alone rewrites who this law is actually for, and it's a much smaller group than the headlines implied. Even for buyers who do qualify, the $10,000 cap is rarely what actually gets saved. The average new car loan today runs close to $44,000 according to Experian's latest lending data. That average loan is currently financed at close to 6.5% interest for a new vehicle. Run that through a normal 5-year loan and the interest paid in year 1 lands closer to $2,000. A deduction only ever saves a buyer their own tax bracket times that amount, never the full dollar figure itself. At a 22% tax bracket, every dollar of deductible interest turns into real tax savings, not a refund. For this buyer, that bracket works out to about 22 cents saved for every single dollar of interest paid. On the interest paid this year, that works out to roughly $440 actually back in the buyer's pocket. $440 is real money, but it's a rounding error against the headline figure everyone remembers. And interest is only half the ledger. The other half is draining value the moment that new car leaves the lot. Edmunds reports that the average new vehicle loses 23.5% of its value in year 1 alone. On that new car, the year 1 drop works out to $9,400 gone before the year ends. Compare that to the used cash buyer, whose car already absorbed most of that steep drop before it was ever purchased. So the ledger isn't a few $100s saved against nothing. It's a few $100s saved against 9,000 lost. That's the hidden cost nobody puts in the headline, and it quietly reshapes who actually comes out ahead. A single year snapshot only tells part of the story, though. What happens once we let both paths run forward together? Let both paths run forward, and the gap between our two buyers doesn't stay flat. It moves in very different directions. Start with the financer, our buyer at $75,000 in income, comfortably under the phase-out threshold. Across a 5-year loan, total interest paid comes out to roughly $6,800, all deductible. That interest, spread across 5 years, works out to close to $1,500 in real tax savings overall. Meanwhile, that same new car keeps depreciating well past year 1, following the industry's typical 5-year curve downward. Industry data from IC Cars puts average 5-year depreciation on a new vehicle at just under 42%. On that same new car, roughly $16,800 of value is gone by year 5. Set that against the $1,500 in tax savings, and the deduction barely dents the depreciation the financer absorbed. Now switch to the used cash buyer, who bought a comparable car already several years into that same depreciation curve. Because the steepest drop already happened under the previous owner, the cash buyer's car loses value more slowly from here. No loan also means no monthly payment eating into this buyer's cash flow for the next 5 years straight. That freed up money can sit in savings, pay down other debt, or simply stay put as an emergency cushion. Now rerun the entire financer scenario, but change one input. Swap the buyer's income to $160,000. That new income sits above the phase-out ceiling entirely, which is where the deduction fully disappears for single filers. Same car, same loan, same interest paid, but the allowed deduction on all of it is now $0. For this higher earner, the new law changes literally nothing about their car purchase decision this year. They still absorb that same year 1 depreciation hit as our first financer did, tax break or not. 2 buyers, 1 law, wildly different outcomes, and only their income decided which version of this story they landed in. So the deduction can genuinely help one buyer and do absolutely nothing for another buyer standing right next to them. But for the buyer who does qualify, there's a variable no spreadsheet can predict, one that decides more than any tax rule. That unpredictable variable is you, specifically what you actually do with the money either path frees up. The used cash buyer's advantage was never the used car itself. It was the $40,000 that stayed in the bank. If that money just sits in a low-interest checking account, most of its theoretical advantage quietly evaporates over time. But if it gets invested or used to erase higher interest debt, the gap between our two buyers can widen. Ask yourself honestly, if $40,000 freed up tomorrow, would it actually go toward your future or your lifestyle? That single behavioral choice can matter more than the interest rate, the deduction, or the depreciation curve combined. The financer carries their own version of this risk, and it shows up the moment a car payment gets missed. Miss enough payments on a car loan, and the lender can repossess the vehicle regardless of any tax deduction. There's also the emergency fund question nobody wants to think about until the exact moment they need one. If financing the new car drains savings for a down payment, one unexpected repair or job loss lands much harder. If paying cash for the used car drains that same emergency fund to zero, the cash buyer carries that risk instead. So neither path is automatically the responsible one. The math only works if the decisions surrounding it are responsible too. There's also a paperwork catch worth knowing before tax season arrives and catches new filers off guard. Starting with tax year 2026, lenders must send a new form called the 1098 VLI, showing what interest was paid. Forget to include the vehicle's VIN on a tax return, and the deduction gets denied outright regardless of income. Even within the same brand, one trim can qualify by final assembly location, while another imported trim does not. So even a buyer who qualifies on income can still lose the entire deduction over one overlooked line of paperwork. All of that raises the question this whole video has been building toward since the very first beat. Given everything on the table, income, depreciation, discipline, and paperwork, which buyer actually made the smarter call? That question doesn't have one universal answer, and honestly, neither buyer in this video made a mistake. Give the financing path its due credit first, because under the right conditions, it genuinely wins on real dollars. For a buyer safely under the phase-out ceiling, that deduction is close to $500 real dollars back every year. Financing also builds a documented payment history, which can matter for buyers actively trying to strengthen their credit profile. And a brand new car comes with a full warranty, meaning fewer surprise repair bills in the first several years. Now give the cash path its due credit, because its strongest argument was never about the tax code at all. No loan means no risk of repossession and no interest compounding, regardless of what future tax years bring. The used buyer also skips the single steepest chunk of depreciation entirely, the exact chunk the new buyer absorbed alone. So here is the actual dividing line between these two buyers once every number gets counted honestly. If a buyer's income sits under the phase out and the loan carries interest, the deduction is genuine money in their pocket. If that income sits near or above the ceiling or the loan is small, the deduction barely moves the needle. In that second case, the used cash path usually wins on total cost once depreciation and interest are both counted. Remember those two buyers who pulled up to the same dealership at the very start of this video? One of them just locked in a real $440 tax break on paper this year. The other one just quietly avoided losing $9,000 of value to depreciation in that very same year. Turns out the government's $10,000 headline was never really the number that decided who won this comparison. If you were choosing between these two cars tomorrow, which one would you actually drive off the lot and why? Somewhere between insurance premiums, maintenance costs, and the next decision after this one, there's always another number worth running. This video is for financial education only, not personalized tax or investment advice, so confirm your own numbers with a professional. Before financing any vehicle for this deduction, verify its final assembly location using the VIN before you assume it qualifies.